There are a number of theories about what would affect exchange rates. The most common and probably the one that makes the most sense intuitively is called purchasing power parity. The idea that if you can purchase a good in the United States for say $5 and you convert that currency into another currency and go into that country and buy the same good, it should cost you the same amount that you can, let's say if it's back to our example where there were 10 pesos to the dollar, something that cost $5 in the United States should cost 50 pesos in Mexico. That you just take your $5, you convert it to 50 pesos, and then you could be able to buy the same good. Unfortunately, that is not the reality in the world, and so we're going to discuss exchange rates in more detail in a few minutes, but just to something you might want to even Google up and look. The Economist magazine has updates every so often a table that they do about how much a Big Mac would cost throughout the world. So in the United States, as of their latest data, a Big Mac costs on average $4.93. If you go to Switzerland, you convert your dollars into Swiss francs. It's going to cost you $6.44 to buy a Big Mac. But if you go down to Venezuela, it's a real bargain. You can get a Big Mac for 66 cents. Again, you convert your dollars into the Venezuelan currency, and then you can, with only 66 cents worth of Venezuelan currency, you can buy a Big Mac. And you can see their table with all of the countries. I think it's somewhat of interest. Okay, so as you may recall when we discussed the closed economy, we talked about the market for loanable funds. And so we had on the x-axis the real interest rate, and the supply of loanable funds came from savings. So and it slopes up. The idea would be that the higher the interest rate, the more likely a person is willing to forego current consumption and put the money in the bank and save it and earn a higher rate of return. And a low interest rate, they might as well consume it now. So the savings, the amount of savings that's available is going to increase as a function of the real interest rate. And then on the demand side, so S was savings. And on the demand side, we had investment, remember? So the lower the interest rate, the more investments become financially feasible, for one thing. And also, when you think about the uses of loanable funds, your own decision to purchase a house, which is also an investment, more houses are going to be sold when interest rates are lower. So the demand for loanable funds is investment. The other side of loanable funds, now our open economy, is also going to be net capital outflow. So there's now two things you can do with your savings, right? You can either invest it here in the United States in terms of investment, which is housing and factories and everything else, or you can buy an asset overseas. So the demand for loanable funds is both, and we discussed this a second ago, right? If the interest rate is lower here in the U.S., you're more likely to want to purchase an asset abroad. So that net capital outflow increases as interest rates go down, makes sense, and then as interest rates go up, it's more likely that folks are going to find investments here in the United States that they want to do. And you could even see negative net capital negative net capital outflow if interest rates get high enough. So this is the downward slope of the net capital outflow, and investment is the demand for loanable funds. So this is the market for loanable funds. Now let's also think about the exchange rates. So we want to think about the exchange rates, and so we're going to have the real exchange rate on the y-axis here, and the demand for dollars. The demand for dollars is really a function of of net exports. The lower the exchange rate, the cheaper goods are in, say, the United States, and the more foreigners are going to want to buy them. And the higher the real exchange rate, the more expensive goods are in the United States, and the less foreigners are going to want to buy them. So the demand for dollars, uh, uh, it's net exports that creates the demand for dollars. So a low exchange rate is going to mean a lot of people are going to want to buy stuff in the U.S., and so net exports are going to be high. We're going to be exporting a lot of goods because people want to buy them, and a high real exchange rate is going to mean less net exports. And the supply of exchange comes from net capital outflow. Now, net capital outflow is not a function of the real exchange rate. Net capital outflow comes from the real interest paid on foreign assets, the real interest paid on domestic assets, the perceived economic and political risks. All of those things affect the real exchange rate, affect net capital outflow. But notice that the exchange rate is not something that affects net capital outflow. You can look at slide 110 or page 376 of the book to see the list of things that affect net capital outflow, and you'll see that the real exchange rate is not one of them. So one of the main determinants of net capital outflow is the real exchange rate. I mean, the real interest rate. So it is the real interest rate that determines net capital outflow. So net capital outflow, we have the real interest rate determined in the market for loanable funds, the supply and demand. It's going to come to a particular interest rate, and that interest rate is going to determine the amount of net capital outflow, the quantity of net capital outflow, which is then going to turn into the supply of currency into the foreign exchange markets. So the demand for net exports is going to determine the real exchange rate, and the supply is determined by net capital outflow. So we have the market for loanable funds determining the real interest rate. The real interest rate determines the amount of net capital outflow, and net capital outflow becomes supply in the foreign exchange market, demand coming from net exports, and so we can end up with an equilibrium, a real exchange rate. Now, this model has a number of implications for policy, and I'm not going to walk through a few of them just so you can understand how this model works. So let's say the federal government decides to run a larger deficit. So there's either a big tax cut or there's an increase in spending, and this creates a budget deficit, a larger federal budget deficit. Well, remember, a federal budget deficit is negative public savings. So savings is part of the supply of loanable funds. So a big federal budget deficit is going to reduce the supply of loanable funds. And so it's going to lead to a higher interest rate. And that higher interest rate, of course, is going to lead to less net capital outflow, and it's going to lead to a higher exchange rate and lower net exports. So this is why sometimes the federal budget deficit and the trade deficit are called the twin deficits, because they aren't identical twins. They don't necessarily move exactly. They're not necessarily the same size, but it is definitely true that an increase in the federal budget deficit is going to bring on forces that are going to lead to an increase in the trade deficit, and vice versa. A federal budget surplus or a decrease in the deficit would unleash these forces that will lead to a smaller trade deficit or even a trade surplus through the effect of interest rates on the real exchange rate and what this does to net exports. So that's one example, a federal budget deficit leading to a larger trade deficit. Now,